Okay, good evening, everyone, or good afternoon, or good morning, depending on where in the world you are. Thank you very much for joining us today. We've managed to put together a presentation by Quilter International on a topic that's very relevant, actually, because I think everyone's been speaking about the US stock market, and I assume everyone that's on here today owns shares in the US as well. And I think this is quite an interesting topic because it's something that I was vaguely aware about, but didn't really know the details because I assumed I'm not American, I don't have a green card. Actually, I've got nothing to do with the US whatsoever. So learning that potentially my US assets could be taxable was a bit of a shock. So hopefully this is very useful information and can help with some of your financial planning, etc. And I just give everyone maybe a couple of minutes to log in. I know some people are always a few minutes behind time, but basically that's the agenda today. This is the webinar and the topic we'll be talking on. This is the rough agenda. So a quick introduction, obviously then the main topic about US estate tax and American shares. A quick market outlook, because again, lots of talking points with stocks generally, but particularly in the US and particularly actually in the last few days. And then we'll give some time for Q&A because I imagine there'll be quite a few questions and it'll be good to get some good answers. Very quickly, so we've put this together, we being IPP, who I work for. IPP are a very comprehensive licensed financial advisory here in Singapore. We're actually one of the oldest and largest in the country, founded back in 1983. As you can see there, 50,000 clients, more than 300 advisors, and over $1.3 billion of assets under advice. This is now the first and second most important slide, according to my compliance department. So hopefully you've read that very, very carefully. It basically means that if you take some advice away from this, that's very beneficial. Please thank us. If you act on your own behalf and don't seek advice, please don't blame us. That's it from me. I'll come back later with a quick market update. Right now, I'll hand you over to Mr. Will Price, who works for Quilter International and is their international distribution head for ASEAN. Over to Will.
Cool. Thank you very much, Ian. Let me just share my slides so I can get started. Let me know you can see that okay?
Yep.
Yep. Okay, cool. So yeah, as Ian said, my name is Will Price. I'm the head of international distribution here in ASEAN for Quilter International. And we are a life insurance company. And I'm going to talk to you about how holding your investments and the structures that you use is very important, particularly with relation to US estate tax. So just a quick bit of background on the company, because whilst we are a very large organization in the UK, our brand is not as large in Asia. In Singapore for, I think it's about 13, 14 years, something now. So we've been here a good while, have some good experience, but just to give you some background on the company, we used to be known as Old Mutual Wealth in the UK, and we separated from Old Mutual and became Quilter last year. The Quilter PLC, which is our parent company, is a FTSE 250 organisation listed in both London and Johannesburg. And we're one of the leading providers of investment management and platforms in the UK and our chosen international markets, managing 110 billion sterling, as it says, on behalf of 900,000 customers. And they have our current rating from Fitch as well. So we're a large, stable organisation and a good house for people to place their investments with. The international part of the business, which is the company that I work for, previously Old Mutual International, now Quilter International, which we rebranded to February last year, so 1 year ago. We are probably the leading cross-border provider of wealth management structures. And when we talk about cross-border, ideally what we are trying to help clients with is providing structures that can move with them if they move countries. So a lot of our clients might be from, say, Singapore and then move overseas, or they may be an expatriate such as myself, someone from the UK that one day may return to the UK or move to various other countries, and we provide solutions that can transfer with you and manage the various different currencies that you have. We've been established for 35 years, as it says, and we have customers in many different countries around the world, and offices here in Singapore since 2008, in Hong Kong, Dubai, Europe, Latin America, and so on. So we do have that global presence. So the main sort of body of what I'm going to talk through today is the importance of how you own your investments. Ian's obviously going to talk later on about the US market in particular, and you know, that might give people some ideas as to how they or what they want to invest into. What I'm going to talk about is how you invest, how you hold those investments, and why it's so important that you consider that. And typically, when we see a typical client that hasn't necessarily taken any advice yet, hasn't spoken to an advisor like Ian, they will have a variety of different investment instruments. They might have some stocks and shares, some ETFs, unit trusts, and so on. And they'll all be held directly with the various different institutions. They may have some unit trusts from a BlackRock, for example, and they may have some shares held on a particular exchange. And every time they want to make a transaction, they need to go direct to those different institutions, provide all of the usual documentation, fill in the paperwork, and so on. And that can be quite unwieldy. It's also quite difficult for people to understand exactly how much their total wealth is, because not everything's held in one place. So the next step on from this, once they start speaking to an advisor, is to try and consolidate their assets onto some sort of platform that can give them some administrative benefits. So the next stage on there is to place these assets into a trading platform. And that gives you those administrative benefits of only having to deal with one institution, only having to provide your proof of address and proof of ID, all those irritating documents that you have to give out endlessly. You only have to deal with one company to do that, which makes life a lot easier from an administrative perspective. And also, because you're dealing with a large institution, they are investing as a large institution and will get better pricing for your investments. So rather than you necessarily paying standard retail pricing, you might be able to access institutional pricing, which will save you considerably in the long run. And typically that's what a lot of clients will do. They'll have their portfolio held within a banking platform, or with a premier bank or private banking relationship, and that's a good efficient structure for lots of people. And the next step on from that, as we would see it, would be to change that platform into an insurance policy or insurance bond. These structures come in lots of different names. Sometimes they're called personal portfolio bonds, insurance bonds, private placement life insurance. There are various different names for these, but they are essentially the same thing. You're taking that same portfolio that you had, but now placing that within an insurance policy. So the obvious question that comes on from that is, why would somebody want to hold those investments via an insurance policy? And something that happens when you move those investments over to an insurance bond is you actually change the ownership of the asset that you hold. So previously, let's say, for example, you held some Facebook shares with HSBC Bank, for example, which are obviously listed in the US. When you move those same shares over to an insurance policy, the insurance company now becomes the owner of those shares on your behalf. So in our example, Quilter International is now the owner of those shares, and you now instead own an insurance policy, the value of which is directly linked to the value of the underlying assets, those shares. And that that contract of insurance that you have gives you right and gives you entitlement to those shares whenever you wish. You can sell those shares, and we as the insurance company would send you cash to the bank account that you tell us to, or we could transfer the ownership out direct to you if that's what you chose to do. And there's some quite important results of that change of ownership. And key to that is taxation, particularly when it comes to US shares, but also some other countries. Before I go on to the US topic in particular, some other countries have benefits as well. So this works well for someone that might move to Australia, for people that move back to the UK, for the same reason that you're removing yourself from direct ownership of those assets. You can get some significant advantages from a taxation perspective. So in addition to that ownership structure, what does an investment bond, an offshore bond, do for clients? It gives you access to a breadth of assets. Our platform at the moment has somewhere in the region of 37,000 assets available for use for clients. So you can invest, buy one of our products, and then go and choose from that broad asset universe. If you have existing assets such as US shares, you can transfer those over without having to sell and then repurchase those shares. Because we are a large institution, then we can offer discounted terms. So same as with a regular banking platform, we have access to institutional rates, so better rates than your average retail customer would receive. And of course, as everybody does nowadays, we do have an online service, so people can transact online for their trading and so on. So on to the sort of main purpose of the talk today, and US estate tax in particular. The style of ownership that I've just talked about, the fact that you are removing direct ownership of your assets by holding them within an insurance policy, can help significantly with estate tax. But before I talk about that specifically, what is US estate tax and how does it work? So anybody holding a US cited asset, on their death, that asset is subject to estate tax. And that includes things like mutual funds, shares, physical property, and so on. And if you are a US citizen, then you have a very generous allowance. So a threshold below which you wouldn't have to pay any tax. And that is somewhere in the region of 11.4 million US dollars at the moment. So unless you have wealth as a US citizen in excess of 11.4 million, you don't need to worry about US estate tax. So for the majority of us, myself included, unfortunately, I don't have that problem. But that only works for US citizens. If I'm not a US citizen, obviously I'm a Brit myself, so that includes me, then my allowance, instead of being 11.4 million US, is only 60,000 US dollars. So if I own that same wealth, mutual funds, shares, property, etc., in excess of 60,000 US dollars, then I have a US estate tax liability on my death. And the rate is a tiered rate, depending on exactly how much more than 60,000 you have. It's a tiered rate between 18 and 40%. You hit 40% once you get up to $1 million US dollars. So it's a very significant tax burden. So whether you touch wood, it doesn't happen, but if you were to die unexpectedly and you hadn't made provision for that tax to be paid, then that's going to have a big impact on what your loved ones received. Alternatively, if you're getting sort of later on in life and your plan is to leave some of these assets to your loved ones, again, if you haven't made provision for that, then you're going to be leaving an awful lot less to them than you had originally intended, after a potential tax bill of 40% on those assets. So what is the solution? And as I've already mentioned, the ownership structure is key here. So as it says, if assets are held in an insurance bond, they're not subject to estate tax on death, because the owner of those assets is Quilter International, rather than you as an individual client. And because Quilter International is a corporate entity, we can't die. So even though you have full benefit of those assets, you can sell them and we would send cash, or you can ask them to be transferred over to your own ownership whenever you choose. So you retain full benefit of those assets. If you die unexpectedly, you don't have that tax liability because the owner of the asset hasn't died, which is because the owner of the asset is Quilter International. The asset that you own is a life insurance policy. And these life insurance policies, whilst we have an office here in Singapore, our headquarters is in the Isle of Man, which is one of the sort of better known offshore jurisdictions. For those that don't know the Isle of Man, it's a small island, similar size to Singapore, which is just off in the Irish Sea, just between England and Ireland. And as I said, it's a well-established offshore financial centre, particularly popular with life insurance companies, trust companies and banks. Because of the strong regulation that's there. So in the event of your death, the owner of an Isle of Man-based life insurance policy has died, not the owner of those shares. So quite a simple solution for removing that liability. If you continue to hold your assets outside of a life insurance policy on a banking platform, for example, you don't avoid that estate tax, because whilst you're holding those assets on a banking platform, you are still registered as the owner of that asset. So if you were to die, then that estate tax liability would be due. And as the final point says there, if you already hold shares, you can transfer them over to us. We don't charge for that service, and you don't need to sell and then repurchase, and any costs that might involve. And also you're not out of the market whilst that process takes place. It can take a week or so for assets to transfer over, but you're not out of the market when that's happening. One thing that I know many clients will be thinking and ask this question, I've been asked this many times myself, is how would the IRS know when an overseas owner of the US assets dies? So if I take myself as an example, I'm obviously living here in Singapore. I might be invested in Facebook or Amazon or Apple because they are very popular. They are driving a lot of the performance in the markets at the moment. How would the IRS know that I died as an owner of those assets? So how would they know to come and claim their tax? And the simple answer is that back in, I think it was 2014, I think, or even possibly earlier, the US brought in something called FATCA, F-A-T-C-A, which is the Foreign Account Tax Compliance Act, very catchily named. And basically that required all financial institutions around the world to report over to the IRS, to the US authorities, about any financial dealings their clients had. So every time there's sort of transactions happening with US connections and everybody uses US dollars, all this information was starting to get passed back to the authorities in the US. So now they have all this information. So it's not a question of how will they know. They will know. It's just a question of when will they get around to investigating it, and is that a potential issue you would want to leave your loved ones with, for them to have to deal with that. On a similar topic, or not relating to the US, is on the back of FATCA, a program called the Automatic Exchange of Information, or Common Reporting Standards, came about, which is essentially the same reporting of information for every other country around the world, or certainly all the signatories, which is most countries that you would want to be dealing with financially. They are now doing that same level of reporting. So everybody's financial information is getting reported to the relevant tax authorities, and there's no hiding anymore, whether intentionally or unintentionally. So yeah, that's when that answers the question as to how would they potentially know about my overseas wealth. So typical sort of clients that would make use of this as a potential solution. You have individuals working for US companies. Obviously, there are many US companies here in Singapore and around the world. I know obviously Facebook have a presence here, Google Amazon and so on. You know, Microsoft, they all have large outfits here in Singapore, especially now that it's become a bit of a tech hub for the ASEAN region. And so there are many sort of senior executives working for these firms, and as part of their package, they will receive shares. And you know that's a big incentive to get invested as part of these companies that you're working for. It's a great benefit for you as an employee. However, it does come with that same liability that you're getting these shares as part of your package, but should you die unexpectedly, you might lose up to 40% of the value of those due to US estate tax. And then the other investor is your typical individual investor. You know, as Ian said at the beginning, everybody wants to invest in the US stock market. It's by far the largest stock market in the world, and everybody wants some exposure to that because it's a great way of getting the returns that they are looking for. So yeah, anybody investing into US shares should sort of consider how they are owning those and the implications of that. Second thing I was going to mention, which isn't specifically related to the US, but is another tax benefit of these products if you were to move overseas, is something called gross roll-up, also called tax-deferred growth, investment growth. And again, this is a benefit of the ownership structure of these products. So in Singapore, we're in a very enviable position that we live in a fantastic country with a very low tax rate compared to many other developed economies around the world. Top rate of taxation here in Singapore is slightly over 20%, 22%. Whereas you compare that to the UK, top rate is 45%. Back in Australia, it's at 47.5%, and so on. So you're living in a very tax benign jurisdiction. Should you move over to another country with a higher tax rate, there are tax consequences to how you hold your investments as well. One of those in particular would be capital gains tax. So, for example, if I move back to the UK, which hopefully I don't have to do anytime soon, but you never know, then if I decide to sell some of my investments, I might be subject to capital gains tax, which could be up to 20% in the UK. If I own my investments in a trading platform, every time I sell and purchase an investment, there might be growth realized and therefore capital gains tax. Whereas if I hold those same investments via insurance policy, again, you've got an Isle of Man-based life insurance company selling the asset. There is no capital gains tax in the Isle of Man, so you can defer that tax to a later date potentially. Yeah, as I said, the investments grow virtually tax-free. So that means that you get growth on your growth and things compound over time. And there's no limitations on the amount that you can invest there. Just to give a very quick case study to give you an idea of the impact of this solution before I finish is we have a client here based in Singapore, 40-year-old on a short-term work contract. Obviously building their wealth for the future, and they have somewhere in the region of $720,000 to invest and plan on adding to that over time as they receive bonuses, etc. If they were to hold that investment and say that $720,000 was invested in the US markets and in shares in the US, there's this estate tax liability. For a $720,000 investment, they would, the first $60,000 of that, they would have this allowance and not have to worry about estate tax. But everything over that, the remaining $660,000 would be liable to US estate tax. And the rate for that particular banding is 37%. So that's a $244,000 tax bill on a $720,000 investment. And simply by changing where you hold that from, holding it direct or holding it via a banking platform to holding it in a life insurance policy can remove that liability. So it's a really simple solution for what is potentially quite a large problem. So I think that's the sort of end of the sort of presentation that I was going to talk through. There are a couple of questions, but rather than go through those right now, I will hand back to Ian to go through the US market outlook, and then we'll pick up the questions after that.
Thank you, Will. Sorry, I was just just trying to unmute. I was talking and no one could hear me. Okay.
The online presentation.
Yeah, technology. Okay, no, thanks for that, Will. Obviously, that was very interesting. And like I said, it was not something that I was aware of, particularly in those sorts of details. I think there's lots of us who own US stocks today. I have many clients that work at US corporations that receive shares, obviously as part of their employment package. And I know quite a few people that had a very fortunate run with Tesla shares, who perhaps a few years ago would not worry about $60,000 being a limit, and today face potentially a very, very, very big tax liability. So, no, very interesting stuff. I'm going to quickly just update on the US markets because we are talking about US shares. One response to learning of this big potential tax liability could be to panic and just sell. And of course, that may not be the best thing. Of course, you avoid the potential tax liability by doing that. But I think there's lots of talk on the stock market generally. It did very well last year. It's done very well at the start of this year. And lots of people are talking about the US. So part of what we do is not just look at US stocks individually, but obviously we manage numerous different portfolios for our clients and provide advice not just on your existing shares, but also on other investments. And I wanted to just very quickly just highlight this. Eagle Eye is our automated portfolio system, and you can see there's quite a few different portfolios for different types of money and different risk profile. Of course, we run probably 30, 40, maybe 50 different portfolios because everyone's in a different position and situation and different needs. But you can actually see here the year-to-date for 2020 returns of our most aggressive portfolios plus 22%, which is pretty good. Last year was quite a roller coaster, I think, as you all know. And versus the benchmark, which was plus 14. Now, one of the ways, interestingly, how we were able to actually outperform the benchmark was using US equities. In March of last year, we really felt that the markets generally, but in particular the US, had fallen too much, too quickly, and just simply actually offered a good opportunity. So across all of these portfolios and across all of these risk profiles, we increased our equity percentage holdings. And in particular, we overweighted America, the US. And that's actually how we were able to deliver outperformance last year. Now, the reason I say this is not just to say how good we are, but it's also just to demonstrate, quite interestingly, just in January this year, we've actually reduced our US equity exposure. And part of the reason is talking about high valuations. Now, after this, I'm going to leave you with two graphs, which will probably cause panic, but then I will obviously explain and hopefully cause some optimism. Because there is a lot of talk about the stock market generally, and particularly America being overvalued. Interestingly, whilst we've reduced our weighting to the US, it is still our largest single country or region out of everything else. So the first one I'll put up is, it's made the news recently. Warren Buffett always makes the news, of course, but this particular, what they call the Buffett indicator, has made the news in quite a few different online articles, and it's been highlighted to me recently by more than one client. Now, as you can see over here, the current ratio, the Buffett indicator, as it's called, is 88%. Now, simply what that is, the Buffett ratio is effectively, as you can see, it's a factor of the total stock market value or market capitalization versus the GDP. So basically, is the market expensive versus, economic output? And you can see here, and this is why I said it might scare some people, you can see here it's actually above the TMT, the internet bubble peak, and quite a bit above it as well. So of course, lots of people panic saying the market is overvalued. I just want to very quickly explain this and put it into context because I think it's important. Interestingly, Warren Buffett himself has just added 9 new shares to his Berkshire Hathaway portfolio. So he clearly doesn't completely follow the Buffett indicator. This is, of course, looking at a broad market, not looking at individual opportunities or stocks or sectors. He's added 9 shares, 3 of which have made the news recently and account for about $14 to $15 billion. So I don't think he sees everything as expensive. But more importantly, what I want to just highlight is market value can mean many things. And actually the market value that's being used to calculate this ratio is not of the Dow Jones or the S&P 500 or even the NASDAQ. It's actually of the Wilshire 5000, which I must admit I hadn't actually heard of. And it's basically supposed to encompass all publicly listed US shares. So many, many companies that we won't have heard of, that have no relevance to our day-to-day life, are included in this. Furthermore, when we look on the other side, that's lots of American companies that do not affect the world generally. When you look on the other side on GDP, obviously GDP is for America in this situation. This is looking at the US GDP statistics. I want to take it with a pinch of salt because as of February the 11th, there is no way to know 2021 GDP. The Q3 for 2020 GDP was only actually confirmed in December. So I would take it all with a pinch of salt. And like I said, you need to look past simply saying, oh, it's higher than it was at the internet bubble. Obviously, the context as well, remember GDP is backwards looking. We're going through COVID-19 related lockdowns. No one's traveling. There's no tourism industry. It's really quite a extraordinary event, which hopefully we're going to start coming out of soon. I've said that a few times, but hopefully we are. So I would put that with a pinch of salt. And again, like I said, we're looking at here the market value being 5,000 US stocks. Many are domestic. Of course, when you look at the biggest companies in the US, many of which we will all probably have shares in, Microsoft, Apple, both of these companies have less than half. Apple's actually only about a third of their revenue actually from America. So they're truly global companies. So we need to actually bear that in mind when looking at this. The next thing, because obviously, whilst economic data is backwards looking, the stock market is forwards looking. So again, there's a big mismatch in that. So we look at price earnings ratios. Again, don't want to scare anyone, but we are now at the same levels, or actually slightly above the levels, again, of the height of the internet bubble, the .com bubble. So that's some pretty scary things. Again, I just want to rationalize that and put it into context. Today, the biggest factor for me, today, we have interest rates anywhere from 0.5 to 0 to even negative in some countries. Obviously, this is the S&P 500 we're looking at. So in America, we're looking at very, very low to zero rates, not just today, but at least for the next 2 years, realistically, probably a lot longer. The interest rate back in this period was between 5 and 5.5%. And it's a huge difference because money has to go somewhere. And that's what I just want to surmise very quickly here. These 6 sort of ticks, these 6 key bullet points, because it's a very, very different world to what it was back in 99, 2000, 2001. The backdrop for shares is allowing much higher valuations than then. I mentioned interest rates just now. If you just include yields as well and think about inflation, when you think about inflation with these low rates, we're looking at negative returns. Again, money has to go somewhere. We look at what is the economic backdrop, all of the stimulus that has happened after the financial crisis, all of the stimulus that continued happening right through to last year. And of course, last year, the stimulus that was put into the economies and the markets by governments to combat COVID and COVID-related things has led to the largest money supply that the world has ever seen by a long way. And this money has to go somewhere. And I don't know many people that want a guaranteed negative annual return. Clearly there are some. Apple just put a 40-year bond into the market, which completely filled at 2.55%. Well, if the US is officially targeting 2.5% inflation, unofficially targeting 3 to 5% inflation, that's a negative return for 40 years. Doesn't sound very appealing to me. And again, you need to keep these things into context, because that's why I think the stock market and even the US market, that's clearly quite highly valued as opposed to overvalued, is interesting. I mean, the dividend yield of the S&P 500 today is 1.57%. That's more than a 10-year bond from the US government, which is currently about 1.3%. So is the stock market expensive? I don't think so. I actually think there's a lot of room for it to come. And the last point I put here is about pent-up demand. We're all very keen to travel, and tourism is going to boom, I think, when we're allowed to again. There is a lot of pent-up demand on so many different sectors around the world that I really do think that these valuations are justified. So anyway, that's me. I could talk about this all day, but I'm just conscious of time, and I want to leave some time for Q&A, because I do see that there are some questions. I think maybe, Will, if you don't mind answering a couple of these, because I think they're certainly the first ones that are targeted more towards the US estate duty and the Quilter proposition. But,
Sure.
So the first one we've got is, do US shares held within a US brokerage account offer any estate tax protection?
So very simply, probably not. They would be still registered in the client's own name. So whilst they're held on a brokerage account, the beneficial and ultimate owner is still the client themselves. Whereas there is a big difference with a life insurance product where the registered owner is the life insurance company. So yeah, my take on that would be no, that wouldn't offer any estate tax protection.
Yeah. Okay. Thank you. And then the next one, which is also to Will, what are the benefits versus the downsides of an irrevocable discretionary trust against an insurance bond?
Okay, so yeah, bigger question, that one, but yeah, I shall cover that. So an irrevocable discretionary trust can't be unwound, as the irrevocable element suggests. The fact that it's discretionary, what that technically means is that there is a degree of discretion that the trustees have as to who benefits, when, how much. So, I might set up a discretionary trust for the benefit of my children, but that gives the trustees some discretion as to exactly when and how much they receive, but they always have to act in accordance with my wishes. Yeah, one of the disadvantages, I would say, is that because it's irrevocable, I as the client can no longer benefit from that. It's for the benefit of my beneficiaries, whoever they may be. Whereas with a life insurance solution, I can still get full benefit of that. If I no longer feel I need that structure, I can collapse that, take those shares back, those funds back, or have cash paid out to me. So that's a benefit. Life insurance is also very useful along with trusts when it comes to quick payout to your loved ones. So with a life insurance policy, we have something called nomination of beneficiaries. So you nominate with a life insurance policy who you want to benefit in the event of your death. And that's a very quick process that avoids probate. So rather than having to wait months, or in some cases even years, for probate to distribute your wealth on your death, with a life insurance policy, it is as simple as your beneficiaries approaching the life company, filling in the relevant paperwork, and then we send the proceeds. You're talking a matter of a week or two to get that settled, rather than months and months for probate. So yeah, there's some good sort of upsides to both solutions, but there is some nuances to exactly how they work and how they fit a particular client scenario. I wouldn't say one solution is always the right one versus another. It does depend on the client scenario, and that's where engaging with an advisor like Ian is particularly beneficial, because they can talk through that, and we can provide some guidance ourselves as well as to what's the right solution for you as a client.
Yeah, thanks, Will. On life insurance, on that side of things, we've got another question just asking if it is a term life insurance, what happens when the term expires? Can it be extended? The insurance bonds you're talking about, do they have a term, or are they whole life? Or
no, they don't have a term. Our particular structures, they are whole of life, as we call it. So they last until either you decide to close them down yourself, or until you die and proceeds are paid out to your beneficiaries. So our structures last for as long as they need to.
Okay, and then an extension to the question is, can the value be transferred to another life assured?
So yeah, with our products that's possible, and you can actually transfer parts of them. The policies that we provide are actually segmented into lots of identical segments. So from a client's perspective, they have one policy, and from an administrative purpose, they're dealing with one policy, but technically it's divided up into lots of identical mini segments. So it's possible to transfer ownership by way of what we call deed of assignment. Either in totality, you can transfer the whole policy to somebody, or you can transfer parts of a policy. So you might have 100 segments within your one policy, and you can decide to transfer 20 to your son or daughter or whoever you choose.
Okay, so it's a very good estate planning tool, not just for the US shares, but generally.
Absolutely. Yeah, and a lot of clients do use it for that wealth transfer process, estate planning, inheritance purposes, and so on. Yeah, it's very popular for that as well.
Good. Okay, we've got one more question here. Is the US dollar 60,000 value limit per asset or per stock, or is that a collective? So if I own $50,000 in Apple and $50,000 in Amazon shares, would this be treated as 100,000, or is it because each holding's under 60, then I don't need to pay the estate duty?
Sure. Okay. So the allowance, the 60,000 limit, is an individual limit. So I, as an individual, have a limit of 60,000. Doesn't matter how that's comprised, whether that's one stock that exceeds it, or I have 20 different stocks that in total exceed it. It's me as an individual that has that limit. So if I have US cited wealth in excess of 60,000, there will be a tax liability regardless of how many different assets that's comprised of.
Yeah, okay, got it. So 60,000 is really quite low.
Especially, and as you said as well, if somebody bought these shares a long time ago, the growth on some of these tech stocks has been phenomenal. So whilst you may not have invested anything like 60,000, it could very easily be worth that or become worth that in the future.
Yeah. Okay, we've got one more question through. So if I own an ETF that does not buy US stocks, but is listed on the New York Stock Exchange, is this counted as a US asset, and would it be subject to the potential estate tax?
That would, because the asset that you're investing into is the ETF. So it almost doesn't matter what that is then exposed to. The asset that you have is the ETF that's listed in the US. Therefore, there would be a liability on that. Yes.
Yeah. Okay. Got it. Anyone have any more questions? I still see there's people online, which is good. If there are, you can just hit the Q&A or chat function and ask. feel free, my email address actually is on the screen. Can you still see my screen actually? My email address is on there. Please feel free to send me any questions, whether it's on US shares or whether it's on this sort of insurance bond structure, or actually on anything to do with financial planning. Also, please contact your financial advisors or business development managers, whoever you liaised with, to be here in the first place. It looks like there's no more questions. So on that, thank you very much, Will. Thank you very much, everyone that's attended. I hope you found that useful. I hope you're slightly worried. I know I am, and I'm going to have to look at moving some of my shares, I think. And again, hopefully I haven't scared you so much that you're going to sell all of your shares. And there is actually a good investment proposition still in this market today. So thank you very much, everyone. Have a good evening or good day if you're in Europe. And yeah, we will send you the recording and look forward to the next one. Thank you.
Thank you.